If we get before you lose next week. Please, Mom. We're going.
Please, Mom. All right. So I think we're live. Hopefully this is working.
I'll look on my phone and see.
It says we're live.
Let's see.
So yeah, I will introduce you, Erica.
Perfect.
Tell us who you're with and what you do.
All right. I am Erica York, and I'm with Fairway Independent Mortgage, and I'm a loan officer. Started in 2004, so made it through the first round of craziness, and here we are again. But a little bit different, a little bit the same when it comes to the lending side of things. But yeah,
right.
That's it.
Okay. So I basically just wanted to find out from you, like, what's going on in the mortgage industry right now? What do people really need to be aware of and know, I guess?
Yeah. So the first thing, and I'm still getting referrals. People still want to buy. People still have to sell. It's just part of our thing. The housing industry has to keep going. And but the first thing that we ask right now is, what is your job stability like? Is your employer talking about layoffs? Are they talking about furloughs? Are they talking about reducing your salary? Things like that. Every case is different. We've had some people that are taking like 3 weeks where they have a reduced salary, or they've now lost their overtime. And yeah, that could come back, but that's just income we can't use to qualify right now unless we have something specific from the employer, stating on May 10th, they're going to go back to 100% of their pay. So that's the biggest thing right now, is just making sure when you get pre-approved and when you're qualified, or if you're already pre-approved with a trusted mortgage, professional, that you revisit that based on these changes. And as we were talking about before we got on here live, is all lenders are going to have borrowers sign like a COVID-19 statement that when they close, nothing has changed with their employment. It's not foolproof, but at least gets people talking about, if there's possibly changes going on, and making sure they can make that first payment.
Okay.
So that's the first thing. Second thing, there has been a few guideline changes just because of first payment default scares. So when rates dropped really low and a lot of people refinanced and a lot of people were still putting in purchase contracts, what the servicers who the loans go to post-closing are concerned about is, are those people going to make their first payment? Because they could lose their job from closing to first payment being due 60 days later. So there's been some tightening of guidelines due to that, just to make sure that we have good viable loans with good employment.
Right.
Yeah.
That's huge. So one question that I get all the time is, where are rates at, and should people think about refinancing right now? So is it a good time to look at that?
So rates are still in the low threes. And of course credit score, loan to value, all that fun stuff. So what I do, and what I hope most mortgage, bankers or loan officers do, is we will have them fill out a refinance questionnaire and see what their current interest rate is, see what their goals are. There are some people that are refinancing. It's not just to get a lower rate, but it's to cash out. That a lot of people have a lot of equity still. So they're cashing out to pay off higher interest debt or to do the home improvements. People have been home for the last month. They're realizing like, hey, maybe this house isn't meant for us, which is where you come in, but they need to do some things and they're still sitting on equity and it will give them the most bang for their buck to do something like that. Or just, just to cash out and thinking maybe later, like I have somebody that's cashing out to then buy an investment property later. So there's a lot of reasons why it is a good opportunity to refinance with rates this low, more than just like reducing your payment. People are taking 15, 20 years, terms and getting out of the 30-year, shaving some time off and still having the same payment that they had before because of the lower rates. So we just analyzed all of that.
Sure.
One thing that was interesting when rates dropped in February which is why we got really overwhelmed, and that funnel is starting to clear right now. But last year, nationally, lenders did $2.3 trillion worth of loans. And when rates dropped in February, they said that $11 trillion of current mortgages would benefit from refinancing. So there are a lot of people out there that would benefit from refinancing. And so it's just finding, the right person to work with and seeing what makes sense.
Sure. So like at what point does it make it worth it to refinance though? Like if their interest rate is currently at 4%, or what should they be looking at, I guess?
If all they want to do is lower their payment and interest rate, I would say 4 or higher.
Okay.
We have somebody at 4 right now, and it's a larger loan. So they're only saving, it's a couple $100 a month. They're saving a couple hundred short term, but they know they want to stay in this house. So they're saving 30 grand, in the next 10 years.
Sure.
Interest. And that's just what we do, is just do that full total cost analysis and see short-term savings, long-term, how long do you plan to stay in the house? Here's the closing cost. Is it worth it for you to do it?
Right.
Because, we're very regulated. We can't do a refi just to do a refi. It has to be a make sense scenario.
Sure. Okay.
But yeah, 4 above, definitely you can get down
pretty
a
low.
point or a little less. Yeah.
Okay. So let's see. Sorry, I got a comment here that somebody couldn't comment. So let me just look at my settings here real quick.
Sweet.
Okay. All right. So if you have questions, try again. I'm not sure why it's echoing there.
No, get outside.
Got kids. So my other question is, at what point does it make more sense to do a home equity line of credit versus refinance and pull cash out?
Right, that's a good one. So home equity lines of credit are fine. I don't really have anything against them, but you would want to have an exit strategy because they're interest-only payments. So, and the good thing about them is they are revolving lines of credit. It's like using your house as a credit card. So as long as you know that you're going to be able to pay back that principal and really have an exit strategy for the amount you use, then they're a really good tool. I have investors that use them and pay them off all the time. But if you're just looking to cash out in order to use that lump sum for one thing, like to redo the kitchen or finish the basement or whatever, I would say that a home equity line of credit is not the most beneficial, because if you cash out, you're paying back principal and interest at a really low rate. If you get a home equity line of credit, you're at a higher rate. It's interest only, and it's really up to you to do something with that principal. Now, later on down the road, if you take out the home equity line of credit and you fix up your house and now you have more equity and you want to do a cash out refinance to pay that home equity line of credit off, that's fine too. Just with rates right as low as they are right now, you know, you could still get the low threes as a cash out refinance. But if you really think you need to have that equity, a home equity line might work better. They're just both different beasts, I guess.
Sure.
But I mean, we have one that we just keep for emergencies, and we don't have a penny on it. But if I were to actually finish our basement, like right now, with rates as low as they are, I would probably do a cash out. No, I'm paying back that principal and interest at a fixed rate.
Right. Okay, so I got a question here.
Yeah.
Is it true that when guidelines changed, buyers who were under contract weren't able to close because they no longer qualified under the new guidelines? And are there any more guideline changes being considered? So what happened?
So a few things that happened were, for us anyways, jumbos went away. So we had a lot of jumbo loans that were locked, and purchases, they tried to move around and get through as much as they could. But a lot of refinances, they had to let go of those. And then down payment assistance loans went away. If you were locked and under contract, no problem, we're fine. And they let those go through. They just weren't accepting any new locks. But some of the things, the main things that happened for us were, if they were already locked before the guideline changes, we tried to let them go through. The only thing that changed where people couldn't go through is where maybe they lost their overtime, and so now we had to take that income out, and they were under contract and their debt to income didn't work anymore. So that really wasn't because of guideline changes, that was just because of circumstances that changed in their job. But as far as, and I think that was most of the reasons why some fell apart in our branch, but as far as the guideline changes, there's been some overlays put into effect. So like for government loans, we're not allowing higher than a 45% debt to income ratio, but that was just as far as application dates starting on March 31st. So if you were under contract prior to that, then you were still fine to go forward. It's mainly pre-approvals that suddenly people weren't, qualifying for anymore, what they were pre-approved for.
Sure.
I know for Chase, Wells Fargo, and Flagstar, so Chase came out that they weren't going to do any loans less than 700 credit score or 20% down.
Wow.
So there were people, and there were people that were under contract that they weren't going to fund those loans. I heard Flagstar went to 680. Wells Fargo went to 680. We went to 640, so we won't do 580 anymore, but we'll do 640.
So I have a question though. I have a question going back to something you said though. So does that mean that down payment assistance programs have gone away, or really?
Yes.
So you can't do CHAFA or CHAC or
we're not doing
nothing.
No, we're not doing any bond loans right now. We obviously would hope to get them back as soon as we can. We don't have jumbo loans right now. It's temporary pause, but just until some of the bleeding stops. So that's why we don't know when the guideline changes are going to stop, or if other investors will follow suit, like Chase coming out saying they're only going to do 700 scores with 20% down. They're one of the biggest banks out there.
Right.
They're also one of our biggest warehouse lines. So if we're loaning to people and our biggest warehouse line is only going to loan on those types of loans, we have 11 other warehouse lines. So we have diversity, but we're also like, any minute, are they going to follow suit So we're just kind of looking ahead to go, well, we can't take these higher risk loans right now because we don't want people to go under contract and then the investors shut it off.
Right.
So
Okay.
we're hoping it evens out a little bit soon, but it's probably going to be a couple of weeks still.
Couple weeks. Wow. I was thinking couple months.
Yeah,
Who knows, right?
hopefully, we'll see.
Oh,
They're
gosh.
saying mid-May, but we'll see.
Okay.
At least for the.
So I got another comment here. Viewer said, pretty sure 27 tax reform, you can't deduct interest on home equity lines of credit anymore. Do you know? I know you're not a CPA.
I'm not an accountant, but that is what I hear also. And that, I think that came from the 2018 tax changes.
Mm-hmm. Yeah.
No
Okay.
deductions on those.
So that's one benefit to doing a cash out refinance is you do get to deduct that interest. So
yeah, and I think there's a cap on. I know I don't get to deduct interest anymore. I think there's a cap on because of the new everything new that came out in 2018. But for some people, they still get to do, which is good.
Yeah. Well, we'll have a CPA next time. Answer those questions.
That's a good idea. With all these refis, that's a great idea.
Yeah. Okay, so another question that I wanted to ask you about is what do people really need to know about these forbearances and, you know, a lot of the mortgage relief stuff? Like, in a lot of ways, it's not really a good idea, right? What do you say?
It's really not. Like, if you can pay your mortgage, the number one thing we need you to do is pay your mortgage. And there's several reasons behind that, because it's not forgiveness. At the end of the forbearance period, they're going to, the number one thing they will do is say, you now owe the 3 months that you just missed in a lump sum payment. Well, then you go, well, I don't have it. I just finally went back to work. I'm just able to make my mortgage payment. So they give you some options, and you can then prove hardship and go into a longer forbearance period. You can do a modification where they spread out the missed payments over 12 months, causing your mortgage payment to go up. And if you've missed a year of payments in forbearance, and then suddenly you can't, pay that back, or you can't pay the modification of the mortgage, they will take that sum with accrued interest and make a secretary lien on a home. So then whenever you go to refinance or sell, you're going to have, if you missed a year of payments and that was $12,000, you could very well have a $45,000 lien on your home that you're going to have to pay off.
Oh my gosh.
The calculations
That's
behind
crazy.
forbearance that people don't see are crazy. And then when you get to the end of forbearance, if you can't pay it, and then you have to prove that you're in hardship or that you need additional help, that's when it wrecks your credit. So they say it doesn't hurt your credit, and it doesn't for that 3 to 6 months. But at the end of that, if you can't catch up and do what's needed, it affects your credit. So it'll be interesting to see how this forbearance stuff plays out, because I did this in 2008 and 9 and 10, 11, 12, and you had to prove hardship, so they had it and it was good for people. But right now, you don't even have to talk to anybody. You can just go to your servicer and click that you want to go into forbearance. And so if they don't really know yet at the end of the forbearance period how many people are going to, be affected.
Right.
So
yeah. Yeah, that's actually one
Scary.
question that we got to is, will that affect your ability to refinance even if you are caught up? Have you heard?
So, and that's what they're working through right now. As of right now, our investors like Freddie and Fannie, they're still coming out with the guidelines. of what will happen. But their guidelines right now state that you have had to have made a mortgage payment on time for the past 12 months. So if it shows you're in forbearance for 3 months, you don't fit into the guideline that you've made your mortgage payment for the past 12. So that's as far as they've gotten right now on how forbearance will affect refinancing. It pretty much, you can't refinance if you're in forbearance or if it's been within the last 12 months. But hopefully they make some changes there.
Mm-hmm. Okay,
Yeah.
so another comment. I'm not sure if it was a comment or a question, but just pre-approval is important, and I know you and I talked about that a little bit. Is that people really do need to be aware of being fully pre-approved, and also, what are the new things that you're having to go through as a borrower, I guess.
Yeah, so we'll touch on W-2, salary, hourly, still the same, pay stubs, W-2s, verification of employment, making sure if they work overtime and have worked overtime that is guaranteed to continue. But self-employed borrowers, they're going to have a little bit of a few more hoops to jump through. We've always had to do, 2 years of tax returns, sometimes one, to figure out income. And then we've always done a profit and loss statement to the year to date, just to show that their income is still in line. Now, if you're self-employed, we're turning in a profit and loss statement at submittal. The underwriter then has the discretion to ask for a new profit and loss statement at clear to close, to make sure that in the month you've been under contract or the 2 months, especially if it's a new build, that nothing has changed and that your income is still in line. So that causes a little bit of extra paperwork, maybe a little bit more time. You got to have the, hand signed profit and loss statement showing the income hasn't changed. Then for the W-2 borrowers, we're doing the verification of employment at submittal of contract. We're doing it at clear to close, and then we're doing it day of funding. So, or the day before funding. We were doing it day of, and that's just too much. Trying to fund the day of purchase is too much. So we're doing the verification the day before so that the wire can be there on time for closing.
Okay,
so just a little.
I got a question though. Like, what if your verification company can't get in touch with that employer? Does that delay closing?
So, yeah. So we actually have had quite a few of those because HR, companies are shut down, HRs are shut down. They have changed the guidelines a little bit where we can use cell phones. Schools are closed, and I've done some refinances for teachers and trying to track down the HR person. We've been able to do it. And before, we've always had to email the verification of employment to a business email. It was not allowed to go to a personal email. They've loosened up a little bit there where we can send it to personal emails. We can call cell phones. We can do things like that to do the verifications.
Okay.
Yeah.
Wow. A lot going on in the mortgage world.
It's a lot. It's a lot. Yeah. But we're still closing loans.
Yeah. So how much would you say percentage-wise are you closing refinances versus purchases?
Yeah, for the first time in a long time, I'm at 45% refis and still 55. And I'm a 90% purchase loan officer. I mean, Fairway is a purchase company.
Uh-huh.
That's we pride ourselves on, and we're still rocking out purchases in 10 days, still making them happen quick. It's still, for asking you, I feel like it's still a seller's market. Now that you're going to be able to go out and show, we still have a supply and demand issue.
We do.
So we're doing all the things that we've been doing to help buyers win deals, close quick, $2,500 guarantee to the sellers, things like that. But I am up to 45% refis.
Wow. Yeah, no, I was looking at the stats just for the last week. We had 750 new listings come on the market and 943 closed. So way more closings than new listings. And
Listings.
so our inventory is still super low, so it'll be interesting. I mean, I do think, there's probably people that, well, I have clients that were waiting to put their house on the market. So I'm pretty sure, the new listings here next month, in the next couple weeks, are probably going to jump up. So we'll see.
Okay. Well, that's what I was wondering is I think I saw that 2,000 how many listings were pulled from the market in the last 2 weeks?
Oh gosh, yeah.
I can't remember the number, but it was a big number.
Yeah,
I mean,
there was 760
okay.
in
it's
2
like,
weeks.
In 2 weeks, yeah. So all of those won't hop on right away probably, but they'll come back on the market, I would think. And then everybody that took their time to go on the market because of this.
Right.
So hopefully we'll have a little bit more options.
Right.
Because I have a few buyers ready to look.
Yeah. Yeah, so again, definitely making sure that you've got a solid pre-approval in place, making a list of homes. We're going to have all kinds of restrictions, even though we're going to be able to show homes. It's only going to be the people who are actually going to be on the contract that can go and see the property. And and so there's a lot of restrictions like that we're going to be subject to. We can't do open houses and some other things. So I have to find masks. I already have booties, so I got that taken care of. But making sure that I have that stuff for clients that don't have it, so that we can still go into properties and look at them. So it'll be interesting. And I think, I think we're supposed to, get some more clarification on that Monday even. So anyway.
Oh, wow.
All right. Well, I don't think I have any more questions. Do you have any questions for me?
I'm trying to think. Well, are you doing, so what does it look like if somebody reaches out to you and says, hey, now that we can go back and look at houses, what's the entire process look like now? So getting but on the real estate side, what's different? What's the same?
So on the real estate side, there's, other than taking some precautions to, really making sure our dates and deadlines are solid if I'm working for a buyer, to make sure that they're protected in the event that, they can't get that verification right before closing. So that if, we do have to extend the closing date for any reason, that we can do that and their earnest money won't be in jeopardy. So I think, I think contract-wise, that's probably one of the biggest things. And then just the showing procedures, the physical showing procedures themselves. So.
And how do you translate a COVID-19 addendum for real estate?
So I haven't had to use that, but I think it's just, a provision where all parties agree to extend things because of circumstances beyond their control.
Okay.
So, yeah.
Awesome.
Yeah.
Yeah, I think that's it.
Cool. All right. Well, thanks for joining me. It doesn't look like we have any more questions, so
okay.
I think that was great.
Thanks for having me.
Yeah, thank you everybody for joining us. And next time I think I'm going to, I've got a bunch of people kind of lined up, but I think one of my favorites is a home stager. So that'll be fun. Nice. Yeah, just,
I'll watch that one.
Yeah, we've all been stuck in our houses for so long. It's like, okay, what am I going to do now?
I know. What can I get rid of? That's everything. That's what I keep asking myself. What can I get rid of now?
Yes.
Make more space.
Exactly.
Cool. Well, you have a great weekend.
All right, you too. Thanks, Erica. Thanks, everybody.
Bye.
Bye.